So good afternoon, everybody, and welcome to our Meritor Q PMS webinar. This is the first time we're doing a PMS webinar on Meritor Q. With me are my colleagues. I'll introduce Onkar Sawant first. Onkar is the fund manager for Meritor Q. He's been working with Marcellus for 4 years. He's a qualified chartered accountant, and he's a graduate of a very famous university, which has produced many corporate luminaries, including I think, the entire board of HDFC Bank. I'm talking about the University of Mumbai, of course. So welcome to the webinar, Omkar. We're looking forward to
Hi.
hearing from you on Meritor Q. And also on the webinar is our quant guru, Krishnan. He runs our investment advisory business. And Krishnan's, prior to Marcellus, he worked at DE Shaw, one of the world's most famous quant investing operations. Prior to DE Shaw, he worked at Goldman Sachs Asset Management, and before that, he studied at IIM Kozhikode. In fact, I got it wrong. Prior to Marcellus, Krishnan was Morningstar. Prior to Morningstar, DE Shaw. Prior to DE Shaw, Goldman Sachs Asset Management. There aren't that many people, Krishnan, with a CV as stellar as that. So I hope you forgive me my mistake. I don't meet people every day who have worked in three institutions with as much of a pedigree as that. So welcome to the webinar, Krishnan. We'll be turning to Krishnan for his expert thoughts on quant portfolio construction, an area where he's the in-house guru at Marcellus. So we'll go straight into the slides which explain to our clients how Meritor QPMS works, and why this portfolio has been so successful in generating stellar returns over the last 18 months or so. The last 1 year actually generated 40% returns, far more than any Marcellus product. So we'll get into the process. Keep going forward, Onkar. So folks, the core of Meritor Q, the core of the investment philosophy is something all of you will be familiar with, which is the Marcellus philosophy. Invest in clean companies, companies who pass our forensic filter. Onkar will explain to you shortly how the Meritor Q forensic filter works using quant screens. Once you've assessed for cleanliness of accounts, look for companies with high return on capital. Again, something that all of you would have heard from us for years, the high return on capital point. And thirdly, not just high return on capital, we also want the balance sheet to be in good shape. So low debt equity ratios, a stable history of profitability. Now, where Meritor Q has chosen to incorporate a lot of the feedback you guys have given us over the last couple of years is we've explicitly made low valuations or affordable valuation one of the screens in Meritor Q. Meritor Q, remember, is a quant PMS, right? It runs on mathematical rules that Omkar will give you more clarity on in the next 10-20 minutes. But one of those rules is we want the companies to be relatively cheap on price to free cash flow yield, not PE. I stress PE has very little predictive power. Price to free cash flow yield. However, we realized when we launched this product 1.5 years ago, price to free cash flow yield has predictive power. So what Meritor Q is doing in simple terms is buying companies with clean financials, strong profitability, consistent profitability, and yet those companies are available at low price to free cash flow yields. This process works really well because not only are you avoiding behavioral biases. Remember, all of us have biases. I, for example, have an affinity for Asian paints, as many of you know. But Meritor Q says Saurabh's affinity for Asian paint doesn't matter. If the rules suggest, if the screen suggests, if the algo suggests that Asian paints is a buy, the algo will buy Asian paints. Otherwise, tough. It'll ignore Asian paints for something else which has better financial strength and has more attractive valuations. Not only are we avoiding behavioral biases, but because we are giving primacy, we're giving centrality to rules rather than discretion. The other human frailties, our inability, for example, to consistently analyze 500 stocks across the BFC 500, MeritorQ doesn't have those weaknesses because it's a mathematical set of rules coded into Python by Onkar and run consistently quarter in, quarter out, and thereby generating stellar results. So I'll now request Onkar to take you through the actual nitty-gritty of the process, how each of these steps of the investment process are turned into mathematical rules. And then Onkar will give you a sense of what sort of results MeritorQ has produced in its 1.5 years of existence as a PMS product. Over to you, Onkar.
Yeah. So, folks, like Saurabh explained here, where we start with is a universe consisting of large, mid, and small cap stocks. So, this will be the equivalent of the BSE 500 or the NSE 500 universe. So, from this universe, the first step that we do is weed out companies which don't have clean accounts. And here we try to define clean accounts by using our forensic paper. So these companies are removed at this step, and then follows the next step, which where we remove companies with a high financial leverage. So you can see that the first two steps are essentially to reduce the risk of the portfolio and also remove high volatility stocks. Then coming on to the third screening steps, what we do is we look for companies who have demonstrated consistent profitability. Why we do this is because we want to avoid highly cyclical stocks. Uh, because in highly cyclical stocks, it's very difficult to predict where the fundamentals will move even over a 1 year period. So we then try to remove them. And then there can also be a case where a company is genuinely undervalued because either it doesn't have many reinvestment opportunities or its existing products don't have a lot of room to grow, right? So these companies, given that they are genuinely undervalued, we look at their growth rates relative to peers as well, and also on absolute terms over the last 5 or 10 years, and then we remove these companies as well. So when we screen out basis these four steps, we get a list of stocks from which we select the companies which will make our final portfolio. So here the selection happens basis both profitability, where we consider a consistent profitability metric for the last 3 years, and then we also consider valuation. Valuation, like Saurabh has explained, we are looking at price to free cash flow here. So we select a list of 30 to 45 stocks, basis these ranks, and then when we get the final list, we try to position size, where we allocate the weights for each of the stocks basis price to free cash flow. Again, a valuation metric. What we want to do here is we want to allocate more to companies which are relatively undervalued. And here I'm talking about relative undervaluation to the list of selected stocks. So, and why exactly are we doing this, right? Because valuation, what we have seen is in years where the market isn't good, the economy isn't going good, our profitability metrics, it protects from the downside risk, right? So the we have seen that the portfolio has gone through much lesser drawdowns in the past. And then when it's coming out of a bad economy phase, it recovers much faster because one, these are profitable companies, and second, these are undervalued companies. So we have seen that this portfolio has also recovered from the drawdowns much faster than what we have seen elsewhere. Then, as a final step, what we are also cognizant of is that we have a corporate governance check as well. There are always cases in the portfolio, although these are just one or two cases, where corporate governance can't be quantified by our forensic framework. So, on a quarterly basis, we go through the final list of portfolio and we remove companies which don't pass our corporate governance check, although this is the only qualitative step that we have in the entire investment process. So I'll just hand this over to Saurabh. Saurabh will break it down into how each of these steps are adding value to the portfolio.
So, folks, Omkar gave you the process. Now, let's look at how this process has made us money. So these are real returns. What you're staring at on the screen are the actual realized returns net of fees over the last 18 months. Over the last 12 months, it's closer to 40%. But let's take the 18 months because I don't think it's realistic to say that 40% returns can sustain. Net of fees returns in the high teens and low 20s is what's sustainable. And therefore, in that context, this number that we have clocked in the last 1.5 years is a good indication of what this can do in the long run, right? So how does the process work? I'll take you through the same steps Omkar mentioned, except that I'll add the mathematics to it. So the first leg, right, where we're simply applying the forensic screen. Remember, the forensic screen is weeding out naughty companies. Omkar will give you more details on the forensic screen shortly. So first leg is applying forensic screen, weeding out naughty companies. Alongside that, we're also saying we want to invest in companies where the return on capital is above the sector median, right? In each of the last 3 years. It's quite a demanding metric. Not once or twice, but above the last 3 years, we want the return on capital to be above the sector median, right? So step one, apply forensics, right? Various forensic rules. Omkar will explain in a minute. Step two, ROCE above the sector median in each of the last 3 years. That first step takes us to around 25.5% returns, right? Then we go to the next step, and this is a what we are doing here is a deviance with market practice. Second step, we are saying, boss, we don't just want clean companies with good profitability. We also want those companies to have low debt, right? So we're removing companies with high debt. At the moment in the stock market, companies with high debt, their stock prices are doing very well. Marcellus is not interested in those companies, right? We're interested in companies not just with clean accounts and good profitability. We're also interested in companies with low debt. Balance sheet should be strong. Debt नीचे होना चाहिए, कम होना चाहिए, right? And we want a historical, long-term historical growth rate, which is very healthy, right? We're not interested in companies whose growth rate has popped up in the last 2 years on the back of some, PSU project wins. We're simply not in that game of trying to do danadan fatafat compounding. So good, clean companies, clean accounts, ROCE above the sector median, which means above average companies, strong balance sheet, low debt, and strong historical track record. Now, notice what happens as soon as we say we want this extra layer of purity, extra layer of strength. The returns drop from 25.6 to 17.5. That's a factor of the current environment where everybody and their grandmother is jumping up and down about the stock market. We don't think that's sustainable. Even if that's how other people want to invest, that's not of interest to us. The second step brings down the return from 25.6 to 17.5. Then we go into, we're now at this stage, we now have around 60, 70 companies. Then the final step is to say out of those 60, 70, build a portfolio of around 35 to 40 companies basis valuation, right? Remember, Omkar mentioned valuation is important here. So we're using price to free cash flow. I stress again, PE multiples का कोई predictive power नहीं है. Price to free cash flow is a powerful metric. It works. It's applied here. And by using price to free cash flow, by pulling in companies which don't not only have all of these virtues which are mentioned here, by pulling in companies which not only have clean accounts, good ROCE, low debt, strong historical growth, but are also available at attractive price to free cash flow multiples, we're able to get to 19% returns. उसमें से अगर आप fees and impact costs you subtract that, we end up at the 18.5% mark. Last 12 months it's worked very well, but over a long period of time, high teens, low 20s net of fees is where Meritor Q will end up, which I think in the context of all cap investors. Remember, the benchmark here is BSE 500, right? So in the context of a product where the benchmark is BSE 500, high teens, low 20s return, I think is very compelling. Now, how exactly do these steps work? I'll request Omkar to take you through forensics, and then Krishnan will take you through the construct around thinking through compelling valuations on high quality stocks, an area where I'm sure several of you will be very interested to hear Krishnan's thoughts. Over to Omkar first.
Yeah. So let's just first break down the forensic screening step, right? So we have spoken about this forensic framework multiple times, but to put it simply, what we do here is essentially we have a set of ratios where if a company scores poorly on all of these ratios, then we classify these companies into a certain category. So you would see here in the top left chart that we have highlighted here first a box of investment grade companies and then subpar companies. So you'll see here that subpar companies over the long term. Yeah, just to stress here, these are long-term returns. So when we say average 3-year rolling returns, these are over the past 10, 15 years. So, subpar companies, usually what we have seen, they give poor returns over the long term, whereas investment grade companies, which we call as the zone of quality, give stellar returns and stellar compounding um, over a longer period. So, this is the first screening step that we do, where we just remove the companies featuring in D7 to D10 and filter in companies D1 to D6 for the screening step. So
Just
if
one
I
second. So I think this worth emphasizing, folks. This is the point we've been trying to highlight, that if you look at this, right, the last 2 years, calendar 22 and calendar 23, you can see subpar companies have done better than investment grade companies, right? So remember, this screen is simply classifying the stock market into 10 deciles basis accounting quality. And last couple of years, lower quality companies have done well. This happens in India every 5, 6 years. Every 5, 6 years, the Indian stock market goes through a bull market phase of euphoria, where low quality companies, subpar companies, have a stellar run. Right? The trick is not to get carried away and invest in subpar companies, because inevitably the subpar companies then go through this extended period of pitai, where they lose 60, 70% of the value. Right? And since Onkar or I don't have miraculous powers to get you out of trouble when once we have got you into trouble, our goal through the forensic screen is to avoid naughty companies. And as the final column is showing you, if you stay invested in quality, the cleaner companies, you get a handsome premium in the longer run, right? So first step for Meritor Q is focus on investment grade, focus on the cleaner companies, ignore the short-term noise wherein lower quality companies are making a terrific return, to the extent that anyway our process is pointing us towards hundreds of high quality companies. No need for us to go into the gutter and look for subpar companies. Now, what Krishna is going to help you understand in the next slide is how this intermarries with the price to free cash flow construct we were describing 5 minutes ago. Over to you, Krishna.
Uh, yeah. Thank you first of all. Thank you, Omkar. Thank you to again Saurabh for introducing, and good evening to everyone. Going back to this portfolio construction step on slide 4, which Omkar talked about, right? So we talked about the different steps, the filtering steps, the initial investment universe, the filtering steps, and the selection step, right? So what we will discuss in this slide, or what we are showing on this slide, is how we go about the selection as such in the strategy, right? So like we said, in MeritorQ, we are selecting both profitable as well as undervalued companies. How do we go about doing it? So essentially what we do is we start with the top 500 stocks in India, right? The BSE 500 stocks, and we kind of, split the entire universe, the BSE 500 universe, into 4 quadrants, which is what you see on the slide. So, if you just picture this, all these quadrants, the bottom right quadrant is the MeritorQ selection zone, right? As such, because this is the zone where you have companies whose profitability again is above median, right, above average, as well as whose price to free cash flow is below average, right, which are undervalued basis price to free cash flow, right? Each of these quadrants, remember, have close to 125 companies. So we take the all the 500 companies and we put it into this this 4 quadrants, or these 4 boxes. And if, again, when we do our analysis, what we have found is, again, just looking at companies, or selecting companies which are most profitable, but which are fully priced in, or doesn't give you the best returns. Nor does investing in companies which are, again, undervalued, but undervalued for good reasons. That also doesn't work consistently, right? What does work consistently is, again, focusing on this zone, where you have both undervaluation as well as profitable companies, right? Which is what we are doing in MeritorQ. So again, going back to what Saurabh mentioned, right? If you go back to the steps in, the number of companies in each step, we start with 500 companies. But, again, we are after, all the filtering steps, we are left with around 70 to 80 companies, right? Now, the 70 to 80 companies which fall in this zone are only the ones which we consider for selection, remember, right? So I talked about, again, 125 companies in each of these quadrants, right? But only the companies which have cleared all our screening steps or all our filtering steps, which fall in the bottom right quadrant, i.e., which are both undervalued as well as profitable, are the ones which are considered for selection, right? Again, the 30 to 45 companies which we select. And this again goes back to, again, when we say, why we say, again, we select companies which are both undervalued and profitable, right? So yeah, I mean, again, I don't need to explain, because Saurabh has already touched upon it, why we consider price to free cash flow. Because again, for any value conscious long-term investor, what we have found, again, our analysis suggests that price to free cash flow can deliver better outcomes than price to earnings. And remember, value of any business is the present value of its free cash flow, not earnings, right? So that's the reason we consider price.
If I could just chip in, folks, thanks to many of you, you were the people who gave us the feedback through 2023, especially that look, you guys got beaten up through 2022 because you invested in expensive companies. Thank you for that feedback. We tried our best to incorporate it in our other investment products as well. If those of you who watched the Little Champs webinar, the Rising Giants webinar over the last couple of months would have seen how we've taken far greater cognizance of valuations there. And the results are there for you to see. Both LCP and RGP have recovered strongly on the back of taking cognizance of valuations. But since that feedback was coming through to us in 2022, late 22, when we were launching Meritor Q PMS, that feedback on valuations has been most explicitly baked into this algo, the Meritor Q algo. And since, as Krishnan just said, the future value of a company is not the future value of a company. Just go back, no. The future value of a company is not future earnings, right? A lot of people think future value of a company is profits discounted. ऐसा नहीं है. The future value of a company is the free cash flow discounted. We believed both from a theoretical perspective that price to free cash flow is the way forward. And then Onkar did plenty of number crunching, which showed that price to free cash flow works far better than PE as a relevant valuation multiple. So you're getting the best of both possible worlds. You're getting good quality companies, clean companies, but साथ ही साथ, alongside that, you're getting attractive price to free cash flow. Every 3 months, this is rebalanced. Every 3 months, this is rebalanced. We will take you through the rebalancing process. Every 3 months, the maths is redone to ensure that the Meritor Q portfolio has the best quality stocks in the BSE 500, which are available at very affordable price to free cash flows. Go on, Onkar, over to the actual track record.
Yeah. So since inception, the portfolio has done considerably well to our expectations, and we have to remember that this is in a context that you can see that the 1 year returns is almost equal to the benchmark returns, and this is after fees that these returns are recorded, and this is in the context where quality companies have relatively underperformed the benchmark and highly cyclical companies as well. And if you remember the screening steps, right? In the screening steps, we are exclusively removing companies which are highly cyclical. So in that context, we think that the portfolio has performed really well. And secondly, there's also one nuance where fund flows also affect portfolio returns. So since this portfolio was launched in November 22, we have gotten quite a bit of inflow since then, and which has also affected fund performance. But if we consider the returns for the day zero investor, the day zero investor has even outperformed the benchmark.
उनका डे जीरो इन्वेस्टर का क्या रिटर्न आया है?
It's 22.5.
So the day zero investor has been able to beat the benchmark.
Yes.
But folks, I think the more serious point Onkar made is in an environment where low quality is doing well, in an environment where high debt stocks are doing well, the fact that this is a company, this is a portfolio of high quality stocks with strong balance sheets, consistent profitability, and we are still being able to stay head to head, neck to neck with the index, I think is what we are trying to highlight. Up to you if you want to go and invest in a portfolio of low quality stocks with high debt. That's your prerogative. Our job is to look after our clients' money by investing in high quality companies. The very valuable feedback you have given us over the last couple of years is incorporate valuation more explicitly. That's been done here, and I think courtesy of feedback, we're able to show you results, which I think do justice to the fact that India has good quality companies available at affordable values. So let's move forward and just check this point out. This whole point around valuation, right? It's a point of big feedback. I think everybody from the security, the CISF security personnel at Mumbai airport to the people who I meet on my morning walk, to obviously our clients and distributors, everybody has told us all Marcellus needs to do is take greater cognizance of valuations. So to all of those people, here is the slide showing you that Marcellus Meritor Q PMS indeed takes cognizance of valuations. So what we have done here, the black line, the solid black line is Meritor Q ka price to free cash flow, right? That line is going up because as the bull market is progressing, valuations are rising. But as you can see at all points in time, Meritor Q ka price to free cash flow is significantly below that of the broader benchmark, PSE 500 being the benchmark. So if you take the average company, average is at 55, Meritor Q is at 33. And if you take the median BSE 500 company, wo to is crazy, it's 870, 879. So Meritor Q is anywhere between 30 to 80% cheaper than the benchmark. And I think the fact that we can buy companies which are consistently cheaper than the benchmark and still maintain a high degree of quality, I think is the signal achievement here. Now, I've shown you here on this slide that Meritor Q is consistently cheaper than the benchmark. Now let's focus on the fact that it's high quality as well. आगे बढ़ते हैं ओमकार. हाँ जी. So you look here. So if you the penultimate row, नीचे से penultimate row is the price to free cash flow as we saw in the preceding slide. That's around the 33 times mark, right? So the previous portfolio was at 31, and the middle column, the portfolio after rebalancing on 1st April, the latest MeritorQ portfolio is at 33 times. BSE 500 is at 55 times, right? Equal weighted benchmark is at 55 times compared to Meritor at 33 times. So we are significantly cheaper. We are around 50-60% cheaper than the benchmark. But how do we know it's higher quality? Look at the ROCE, right? Meritor ROCE is around 30%. Interestingly, this is very similar to CCP ROCEs, LCP ROCEs, RGP ROCEs. This 30% ROCE is the hallmark of successful Indian companies. Remember, as we've already discussed, the reason successful companies grow faster than the market is they reinvest more. If a company has ROCEs of 30%, even if they reinvest 2/3 of that, they'll be able to grow earnings at the 20% mark. So Meritor Q ROCE is 30. Look at the middle column. BSE 500 ROCE, on the other hand, is 20. So you're getting a portfolio which is significantly better than the market, 30% ROCE versus benchmark at 20% ROCE, and yet the portfolio is significantly cheaper than the benchmark, right? You're having your cake and getting to eat it too. Acha portfolio, superior to the benchmark at valuations which are at a discount to the benchmark, right? आगे बढ़ते हैं ओमकार. So the other aspect is where do we not invest, right? As you would have guessed, Marcellus does not invest in real estate and energy. So those are the zero weightings. So the middle column is showing you the sector weightages for Meritor Q. We're not investing in real estate and energy. Remember, this is not human discretion. The rules that Meritor Q follows, which is good accounting, good ROCs higher than the sector median, a stable profitability, low debt equity, right, and affordable valuations. Basis those rules, communication services, which is telecom, energy, and real estate, unfortunately, ka zero representation hai. Again, those sectors have done really well over the last 1 year. Anybody who's invested in them, we wish you well, but unfortunately, it doesn't suit our house style, so we stay away from them. And then sectors which naturally work in the context of the rules here are, say, consumer staples, right? तेल साबुन 11% weighting, index के मुकाबले index में 7 है, Meritor Q में 11 है, but similarly healthcare 16% weighting. So sectors with good ROCEs, stable profitability, good balance sheets, clean accounts, Meritor Q over-represents those. And if you look at the niche wala part of the slide, the size allocation, Meritor Q is heavily overweight large cap, right? This is a point of big departure from many other portfolios in India. Meritor Q is heavily overweight large caps. We have over 40% of the portfolio in large cap. In fact, over the last 6 months, they've increased the large cap weighting further. whereas index में large cap का weighting केवल 20% है. Naturally, therefore, we are underweight mid caps. Mid caps are the favor of the season. Everybody and their grandmother is running to put money into mid caps. So much so that the regulator SEBI told the market around a month or so ago. The regulator called up mutual fund houses and said, "Boss, ठंडा हो जाओ. Small and mid cap MFs में पैसा कम लो." Right. So in a time where small and mid cap valuations have been overheated, we are underweight mid caps and we are overweight large caps. Right now, let's move forward, Onkar. This point on large caps का weighting बढ़ाना, we wanted to show you more graphically. So देखिए, the blue, light blue, the sky blue shading, the sky blue shading is the ramp up in large cap weighting that we have done over the last 5 months in Meritor Q, right? We've progressively increased large cap weighting. Now, why have we done that, right? We know that mid caps are really hot. Even our mid cap portfolios are doing ever so well now. Why are we increasing large cap weights? Right, we'll answer that in the subsequent slide. There's plenty of data to show. Move forward, Onkar. There's plenty of data to show that this is the time. If ever there was a time to ramp up big time on Indian large cap, that time is now. वो time आ गया है. कैसे मालूम हमको? So the orange line, the ऊपर वाला line, is the share of the top 20 companies in the BSE 500 in the PAT of the BSE 500. So top 20 का PAT share, top 20 500 companies का PAT share is around 49% today, much the same as it was a decade ago, right? So करीबन आधा PAT BSE 500 का, half the PAT of the BSE 500 companies comes from the top 20 companies, 20 mega cap companies, right? HDFC Bank and ICICI Bank and SBI इत्यादि. But look at the market cap contribution of the top 20, right? It's at a decadal low, 43% a decade ago. Now it's become 33%, right? Now, even if I don't have Krishnan's pedigree in quant analysis, right? I can see from this chart that large caps are incredibly attractive relative to small caps and relative to their own history, right? So, दो तरीके से large caps are very attractive. The relative to small caps, because देखिए, if large caps weightage has fallen from 43%, if large caps weightage has fallen from 43% to 33%, then that necessarily means small cap का weight बढ़ गया होगा. So the first way large caps are very attractive relative to small caps is relative to small caps, large cap का market cap weight गिर गया है. Large cap profits are holding strong, right? Half the PAT in the stock market, half of it comes from these giant companies as it did decade ago. So PAT share constant है, market cap share टूट गया है as the retail investor has entered the Indian stock market and has gone berserk, loading up on small caps, right? How do we know retail investor has entered the stock market and gone up berserk buying small caps? Because SEBI ने data छापता रहता है. SEBI has छापोट data saying that demat accounts today are 15 crore. 3 years ago, demat accounts were 3 crore. So 3 साल में, 3 years में, the number of demat accounts has gone from 3 crore to 15 crore. And SEBI has also published data showing that most of that retail money has disproportionately gone into small caps, jacking up small cap weights into the sky. But thankfully for us, reducing large cap weights, right? Agar large cap profitability had got compromised in the time, अगर large cap profitability had got compromised, हम नहीं करते large cap में load up, but large cap profitability is holding on strong, right? As you would have heard in our CCP webinars, for example, HDFC profit में कोई problem नहीं है और ना ही TCS के profitability में problem है. So large cap profitability is holding on strong, and at the same time, a large cap market cap has fallen. We believe that's a great time to load up on. That's a great time to load up on some of India's largest, most liquid, strongest franchises. Hence, over the last 6 months, steadily, Meritor Q has ramped up the weightage in large caps. We will see the fruits of that come through over the next couple of years. But this is a big strategic call that we have made using the underlying algo, but also using judgments. On this point, judgment has been used to raise the weight of large caps in Meritor Q. Let's move forward, Onkar. I think it's Krishnan who will now talk about the underlying philosophy.
Sure. So when we think of Meritor Q, we can think of this as a portfolio of underdogs, right? So you can think of again underdog as a team or an individual or even a company, right? Where there is a lot of potential, but essentially the expectations are very low, right? So in fact, my favorite underdog story is the Indian cricket team in 1983, right? Again, prior to the tournament, India was not even considered to be a strong team then, and wasn't given much of a chance to win the tournament, right? Um in fact, again, I don't know how many of you were alive at that point in time, but it seems that again India's return ticket was booked on 20th June, whereas the finals and the semi-finals of that the tournament was actually on 22nd and 25th June, right? So even the team management themselves didn't believe that India will go beyond the group stages, right? But we all know that again it was Kapil Dev's that stunning knock against Zimbabwe, 175 not out, and then eventually the team went on to win the World Cup and causing a big upset by defeating West Indies, who were kind of the reigning world champions then. So in a similar way, when you think about Meritor Q investing in underdogs or companies that are not well known or highly valued as their peers, right, it can often pay off, right? Because because these companies have potential, like we said, right? We are filtering for all those steps. We are making sure that these companies are checking all those boxes which we have talked about till now, and we know that these are good healthy companies, nothing wrong about them. So once you invest in these companies, so essentially once the price of these companies revert back to their fair value, investors get the benefit of the price appreciation. And again, we also talked about this, right? We're not only selecting quality undervalued companies, but also avoiding well-destroying companies like Satyam, DHFL, Cox and Kings, with our forensic screen, for example, right? Now we go through this this checklist, or this set of steps 4 times in a year. So the first trading date of January, April, July, and October. So again, fixed rebalancing. So rebalancing helps us in 3 ways, right? Number one, it helps you to bring in undervalued stocks regularly into the portfolio, and get rid of again companies whose price has reached their fair value, or also reduce the position sizing in companies where the prices have kind of either appreciated or kind of got closer to the fair value as such, right? And once you bring in undervalued stocks in the portfolio, typically we'll hold these stocks for another 1.5 to 2 years on an average, and again the whole process kind of repeats. Rebalancing also allows us to reflect any change in the fundamentals, right? The business fundamentals of these companies. So, for example, if you think about a company which made it through a forensic screen, say 6 months back, right, but no longer makes it through all those checks which we do, right? All the 11 or 10 ratios which we use for our part of our forensic screen, that company will be thrown out, right? So again, any change in the fundamentals, it gets immediately reflected, and the company will be removed from the subsequent rebalancing 6 months hence or 3 months hence. Also, remember that again, by the very nature of rebalancing, it's contrarian, right? So a company whose share price has appreciated, the rebalancing will ensure that its position sizing is removed, so it's reduced, or the company will be removed. So that essentially ensures that we are not kind of concentrating our position in a particular stock, right? So the rebalancing as a mechanism ensures that again we are not our position sizing is not concentrated in one company or a couple of companies. So again, rebalancing again regularly across 30 to 45 stocks in Meritor Q, in the way we have described, allows us to, number one, again make sure that we benefit from the rise in price of undervalued stocks as they mean revert to their fair value. 2, reflect change in the fundamentals, and 3, controlled risk, right? Obviously, when you combine all this, it maximizes the wealth creation potential for investors. Over to you, Omkar.
Yeah. So, folks, we have just discussed the rules quite in detail, but let's just take one example where we have seen these rules actually perform in the portfolio. So here we have highlighted the case of Star Cement. So for anyone who doesn't know, Star Cement is one of the leading cement producers in Northeast India. They also have manufacturing facilities in Bihar, West Bengal. Uh, yeah, but here what is important to note here is that when we started with Star Cement, we started with a 5% allocation in the portfolio. So Star Cement cleared our forensics filter, so which gave us a fair picture of the company, the management being honest, and also gave us a fair picture of its financial health. Secondly, it has negligible debt. You can see that the net debt to equity ratios is almost close to zero. And yeah, and it has also in the cement sector a consistent profitability ratio. ROCEs of 12% is usually unheard of, and Star Cement has consistently they have also shown that. So, basis these screening steps, Star Cement got an allocation of close to 5% in the portfolio. And at the time of inclusion, it was generating an free cash flow of around 200 crores, and its market cap was close to 4,000 crores, if I'm not mistaken. Then what we saw was over the next year, its share price, you can see here the blue line, its share price went up over 70% over the next year, and its allocation kept coming down as its valuation got more expensive. So you can see that when we started with the allocation, with a 5% allocation, the price to free cash flow was just 18 times. But now that the Meritor has exited from Star Cement, the price to free cash flow is at more than 100 times. So this is essentially what Meritor Q tries to do. This is just one of the examples, but there are many more such examples that we have seen in Meritor Q. And the point here is to own a basket of these case studies and just benefit from it. I'll just hand over to Krishan now to explain us more into the quant philosophy
Just
and
one.
how.
So before we hand over to Krishna, just to emphasize, folks, Star Cement today is as classy a company as it was when we invested in November 22. The reason for exiting is the 105 times price to free cash flow multiple. Star Cement, for those of you not aware of the franchise, basically they are the dominant cement manufacturer in Northeast India. So if you ever go to Assam or Arunachal Pradesh, you'll see everywhere, the main cement being sold is Star Cement. Sanjay Agarwal ji, the promoter, has done a wonderful job. And it remains as powerful a franchise today as it was 2 years ago. Just that, as Omkar is showing you, the price to free cash flow 18 guna se 105 ho gaya hai. And that led to the position size being reduced from 5% to 0%. Over to you, Krishna.
Sure. So we can just, yeah. So what I'll do is I'll just briefly touch upon the benefits of, of this quant approach we have taken specifically in Meritor Q. So when you think about quant, right, or, generally if you think about investing, there are, two, main approaches, to active investing or, active management. One is obviously the systematic investing style. Other is the discretionary investing style. Discretionary investing, I'm sure all of you are aware, it's a traditional investing style, where a particular portfolio manager, human fund manager generally will take a call on which stocks to buy, what position sizing will there be in that stock. So I'm not going to dwell on that. So essentially, it's, when you think about systematic or quant strategies, what they do is typically they apply a repeatable and a data-driven approach, right? Usually relying on an efficient algo or using computers or programs to identify investment opportunities across many securities, right? So typically, this is how you can divide the active investing into these two areas as such, right? Now, when you think about quant investing as such, right? When I speak to when I speak to people in India at least, right? So typically people associate quant with again either momentum or technical trading, whatnot, right? Again, when you think about the approach we have taken in Meritor Q, of course it's quant, right? But it's actually again we are looking at a rules-based approach. Again, that's where I would say it's more quant. But we are looking at stocks with good, sound fundamental attributes, right? This is where we are combining our fundamental insights and our proprietary frameworks, and we are using a disciplined, rules-based manner, right? Now, globally, what this approach, maybe in India, it's just taking off. This approach is called what is called as a quantamental approach, where you combine quant and fundamentals. So, when you, look at it globally, right, one of the earliest pioneers of, this kind of an approach was, Warren Buffett's mentor, Benjamin Graham. In fact, you can call him, maybe the world's first quant. And then, there have been a lot of other luminaries, right? So, again, if you're interested, you can look up, this book called, this Magic Formula by Joel Greenblatt, right? The little book that beats the market. So, of course, there's a lot of, money tied, real money tied, in developed markets on such strategies, which which combine both quant as well as fundamentals, even though in India, it's still, a nascent space as such. So, again, when you think about Meritor Q, it is the quant plus fundamental approach which we have taken, right? We have consciously tried to avoid what is called as a LSD in investing, leverage, shorting, derivatives, right? It's a completely long only strategy based on good investing principles. And like I said, based on our proprietary investing framework like forensic screening, whatnot, right? And again, going back to what I started with. So while you can say quant and discretionary are two different areas as such, or mutually exclusive, quant and fundamentals need not be mutually exclusive, right? And the approach we have taken is quant and fundamentals in Meritor Q.
I think, Krishnan, in the interest of time, it's worth taking clients through the behavioral biases, the psychological biases that impact all of us. If you could just explain them and then give an
Sure.
example of how Meritor Q helps us deal with the biases which pollute our thinking.
Sure. If you can skip to slide 20. Okay. Yeah, this one. So, if you think about, again, one of the advantages of quant investing, I think Saurabh alluded to it when we kicked off this webinar. One of the advantages is it's obviously objective. It helps you to avoid biases, right? Now, what are biases? Essentially, they are mental shortcuts, right? So obviously, human beings develop this mental shortcuts or these biases, which are helpful in a lot of situations, right? Real world situations where you need to respond quickly. But it has actually been shown through various studies that, again, biases are actually a drawback when it comes to investing, right? And in fact, there's a separate field of study called behavioral finance, right, which possesses that, again, investors do not analyze all economic opportunities or all opportunities in front of them clinically, right? And even if they do, they're just taking bits and pieces of information and, kind of ignoring the others, right? More relevant pieces of information. Traditional finance, again, assumes investor rationality. But again, behavioral finance assumes takes investors as such and assumes that, again, they come with all these frailties, right? Now, given, again, there are a lot of examples of the different biases, etc., which I have listed down here: loss aversion, recency bias, hindsight bias, and we can go into all of them in detail. But given the time limitation, I'll just focus on availability bias here and how the quant approach we have taken in Meritor Q helps to avoiding it. So availability bias, just coming to the definition, right? It refers to the human tendency to use only readily available information to make decisions and ignoring what's hard to find, but actually is more relevant, right? So what happens is, this leads to investors ascribing higher frequency to events for which information is available, easily available, but again, it's not relevant, right? So just to give an example here, right? Let me ask you a simple question, right? Again, I'm not able to do a poll here. We don't have enough time, but if I ask you, who, do you think more people in India die out of, from tuberculosis or they die from road accidents? What would be your answer? Right. So if I ask you that question, typically you would say, more people, die out of road accidents, right? But actually, it's the other way around, right? In fact, in 2022, almost double the number of people died from tuberculosis, right, or TB, than road accidents, right? And a simple explanation for this is that, again, road accident cases are reported regularly on the third or fourth pages of, newspapers or, your local dailies. Whereas TB-related deaths do not get equal attention, right? So again, classic availability bias, if you think about it. right? So in investing, if you think about availability bias, right, a lot of examples can be given. One, way to think about this is, overreaction to market news, right? So investor might, for example, react negatively to the news of a product recall of a company, right? When in fact, the product recall might actually be irrelevant to the company's business, right? Or the company's, the impact on the company's business as such. Whereas on the flip side, it can also happen that a company might be rather tight-lipped, right? But it is fundamentally sound, but it never gets the attention it deserves, right? And again, this bias then has a detrimental impact on how the way you create the portfolio and the way you go about selecting stocks. Another example is maybe this is true for, I think, a lot of fund managers, because typically fund managers rise through the rank of an analyst, right? So they typically tend to favor the sector they would have usually covered, right? Or they might have they would be more comfortable in certain sectors than, for example, sectors they have not covered in their experience. So what happens is when they become a fund manager, they might be more predisposed to something they are more comfortable with, the sectors they have covered, rather than look at again areas or sectors which are outside their comfort zone. So when you think about MeritorQ again, the systematic rules-based approach, again, the charts which we have shown here, the first one, that basically tells us, how we try to avoid availability bias. One data point here is, again, when you look at the left chart, 13% is being the average allocation in MeritorQ towards stock with low analyst coverage, right? While it actually might look low, but this is again an average, and again remember that again this is also the set of companies, right? What we have seen, they are actually more undervalued versus all other companies in the portfolio. And again, no surprises there, right? Companies which have low analyst coverage typically tend to be less discovered, less known in the market, and typically they trade at a higher discount to their fair value versus other companies, right? So MeritorQ, because it's objective, it's not swayed by availability of information or by popular opinions. It can select these companies, even if a traditional fund management process might ignore these companies, right? Another data point.
The risks. Let's highlight the risks with our process. Let's highlight the risks with MeritorQ, and then let's open it up to Q&A.
Sure.
Go on, Krishnan.
So, again, just, we have obviously touched upon, all the advantages, but, two risks to, this quantitative approach. One is obviously it's based on past relationships. And again, past can only be an indication towards the future. It's no guarantee that it might work in the future. And obviously other disadvantages, the rigidity in the rules, right? Especially when there is a regime shift. Again, COVID is a classic example, right? Where, no one would have, kind of guessed, what would have happened, that, so, it would have been so, the disease would, be so widespread and, it will, take such a global scale. But, that's what happened. And that's where, human fund manager would have an advantage, you might argue, over a quantitative or, a rules-based approach, right? So unknown unknowns, right? That's where quantitative approach would struggle when you compare to a human fund manager. But again, just, mitigants for, again, the way we have built this process, what we have done in MeritorQ. One, the regular rebalancing addresses the risk associated with, this, the dependence on past relationships, right? Because again, we are refreshing the portfolio every quarter basis, both fundamentals and valuation, right? And regarding the second, the drawback, where we, again, quant processes, again, they are rigid. What we have, said from the very outset when we developed MeritorQ is, one is, the rules are not static, right? Obviously, the rules which we came up with, they are in line with the overall fund objective, but by no means, going forward, we are saying that, this will be the same rules going forward. We'll keep on working on, enhancements to these rules or how we go about actually implementing these rules to make sure that they are in line with market realities. One, at the same time, they adhere to the investment objectives of this product, MeritorQ, which is buying good quality companies at reasonable valuations, right? And yeah, I mean, again, this, the whole approach we have taken is humans and machine working in parallel, right? Where humans, again, whether it's Omkar or, whether it's a research team, we are coming up with a thesis and we are testing out that investment thesis, right? But we leave the implementation and the data crunching to be done objectively by the machine, right? So this is the rules-based approach.
That's the appropriate point to hand over to Pramod. Pramod, if you could moderate, I think there's a whole bunch of questions lined up. If you could help us deal with those questions, Pramod. Pramod, you on the line?
Yes. So yeah, folks, happy to take as many questions as possible. There's a Q&A box at the bottom of your screen. Please fire away while I start taking the questions which are already in that box. So Krishna, there's one question on judgment used to ramp up exposure to large caps. Is it judgment driven or is this also formulaic? Worth throwing some light because the gentleman who's asking the question is a little bit confused. If the whole point is to avoid judgment bias, how are we incorporating the shift to large cap from small cap or vice versa?
Sure. So it is formulaic. I mean, it's driven by an overlay to the rules which we have. But yeah, I mean, to a lot of extent, if you actually think about it, right, the valuations themselves, right, the way we have built the system itself takes care of it, right? Because we are relying on valuations here, it is inherently contrarian. So if tomorrow, that's what happened in last year, right? If tomorrow a lot of companies in small mid caps, they run up, right, 40-60% up, right, versus large caps. So you get a lot more opportunities to pick companies from large caps to the extent they clear all our filtering steps, right? So to that extent, you have a greater probability that more large caps will make it into your portfolio versus small mid caps. But yes, we also do this in a more formulaic way also. So we have an overlay which makes sure that we tilt our portfolio positioning consciously towards large caps basis a signal.
Right. There's also a question around debt. When you talk about low debt companies, if say the business model requires a base level of debt to fund future capex or to optimize capital structure, doesn't that rule out certain genuinely good businesses where debt is a crucial element of doing business in that particular industry?
Look, I mean, our comparison of leverage is again versus the peers, right? So if, for example, to your question, if a particular company in a particular business, maybe it's an infrastructure company, right? Or if it's more debt heavy, kind of an industry where where you have projects with long gestation period, then yes, I mean you're comparing versus your peers. But if it's scoring worse than your peers on, again, debt metrics, whether it's the coverage metrics or, again, other debt to equity or, other marketplace metrics, then obviously, it will be removed from the portfolio.
Right. There are quite a few questions around the taxation impact. Clearly, the rebalancing triggers its own churn, as you've talked about. And as we all know, churn also results in incidence of taxes. Have we done any sort of ballpark calculation to suggest what could be the post-tax return or the impact of taxation on the net returns in the hands of our investors?
Yeah. Pramod, so even after considering the taxation, the fees, and the dividend yield, of course, so net investors can expect around 17% returns. That is what I have seen this portfolio to give in the past.
There you go, folks. So even post tax, there is a reasonably healthy return to be achieved here. There's a question around timing, saying I want to invest more in Meritor. Is there any difference in terms of when you invest? Is it appropriate to time that investment at the time of rebalancing or midway through 2 points of rebalancing is there? Does it really matter? Is it a random event?
No, it doesn't matter. So timing is irrelevant, especially if you are investing through the PMS, right? Maybe for someone who is more sensitive to churn and who are investing, they don't have a very long-term horizon. So maybe they might want to invest, they might not want to invest, say, a week before rebalancing. But otherwise, I don't think it makes any difference.
Thanks, Krishnan. There's also a question in terms of reducing the position size versus completely exiting the stock. Is there a particular reason for the same? Is it just to facilitate the purchase of other undervalued stocks, or any other reason behind? How do we arrive at position sizes?
So the position sizing is done in a way, again, where we assign higher allocation to more undervalued stocks within the portfolio, right? So the position sizing could go down, either because the stock has gone up in price, right? And again, we are when we say position sizing, again, all this changes. It's relative to all other stocks in the portfolio. Right. So if a stock, in the portfolio has done really, really well versus all other stocks in the portfolio, and also with respect to all, other stocks, which are within the investable opportunity set, i.e., which have cleared all our filtering, steps, then yes, either, most likely that stock will be removed from the portfolio. And in extreme case, again, if the appreciation is less, then the position sizing of that stock would be reduced.
Right. There's a question around clarification that the cycle seems to be turning from value to quality again. As you can see, of late, value stocks have underperformed. Despite that, Meritor has done well. How should we read this? My sense is the implicit understanding of the person asking the question is Meritor is actually a value fund in the traditional context of value stocks. How would you like to respond to that, Krishnan?
So look, I mean, quality and value in India, they typically, the correlation between, if you think about them as factors, right? It's either the correlation is very low or it's negatively correlated, right? So, typically when quality does very well, which is what Omkar mentioned, right? During market drawdowns, typically that's when value stocks don't do that well. Right. And it's actually vice versa when you are actually coming out of a drawdown, right? The quality stocks kind of, lag value stocks as such. So that's the advantage of, having the exposure or, going with this kind of a portfolio construct, right? So where, at least one of the legs of, the either quality or value are firing at any point in time. Right. So if they're, both of them are doing really well, great. But even if one of them is firing, which is more often than not because they're negatively correlated, it should, help investors to do well or help the strategy to do well.
Right. Now, one of the disadvantages which you haven't talked about is, say, in between two rebalancing, if there is a catastrophic event, which is a stock-specific event, say what happened to Kotak Bank last week. This strategy doesn't allow you to respond to that. Is there a way we can incorporate that?
I would argue that, look, we have, kind of thought about this. I would argue that, generally, when the news comes out, generally it's quite late, right? So there's no point in reacting after the event, right? Especially, when there is a negative regulatory development or, when there is a corporate governance news, whatnot. Typically, again, like I said, right, we try to reduce, this kind of a risk of, having to, kind of intervene in between two rebalances as much as possible through our forensic screen, through our corporate governance check as much as possible. So reducing the tail risk in the portfolio as much as possible, right? But of course, like I said, right, negative regulatory developments in any of the stock, could always, affect, portfolio companies. And I would argue that, in fact, the kind of companies we have or, the kind of companies we are looking for, they're actually resistant to, or they can overcome this kind of negative developments. And in fact, case can be made that unless the fundamentals have really deteriorated, right, which will obviously be picked up by our fundamental screen, there's a case to be made that you should actually increase the position sizing in such stocks. Right. So to answer your question in brief, generally it's too late to do anything when after the news has is released. So that's one reason, and obviously through our portfolio construction as such, we try to take care of this risk at the the screening and the selections stage itself.
Right. There's a question around position sizing, intra rebalancing. So you arrive at the position sizing based on value on, say, January 1st, but let's say stocks have bounced around between January 1st and February 15th, and hence the value has changed, right? Free cash flow yields could have changed. Somebody investing intra rebalancing, say on 15th February, would that take the position sizing as of 1st Jan, or would it dynamically reflect the value movements, the price movements in the interim?
No, it would be as of 1st Jan, right? So it will not, for someone who is investing, with us on 15 January, we will get the same portfolio which we created or which we went live with on 1st January. And again, if you think about it, because this is a value-based selection, what would happen is if for example some stocks in the portfolio have appreciated since rebalancing, just going back to the model portfolio allocation, that itself will ensure that you're actually now holding more of stocks whose less of stocks whose value has appreciated and more of stocks whose value has appreciated during those 15 days, right? So the just go buying the model portfolio ensures the or is in line with the value-based selection, which is part of the fund philosophy.
Right. There's a question around accounting checks. Looks like there's a lot of effort involved here. Have we sort of automated using Python, or is this done manually where a bunch of analysts are sitting down and looking at the reported accounts?
No, this is completely automated. So there's absolutely no manual intervention as such in any of the steps, right? Till we get to the very last step. Again, going back to slide 4, which Omkar talked about, again, all those steps are completely automated, right from, the 500 stock universe to, when we get to the final 30 to 45 stocks. And it's only on the corporate governance check, which we do on those 30 to 45 stocks, is there judgment involved, right? And again, there's for good reasons where we want to ensure that, again, there are no hidden corporate governance risk or unquantifiable, corporate governance risks in the portfolio or in the portfolio companies. Like, for example, crony capitalist or, promoter integrity issues. So that's the only step, again, which is not automated, which we can't automate, but otherwise nearly all the steps, right, from, the investment universe to the final portfolio creation is completely automated.
Right. There's a question around the number of stocks in the portfolio. At Marcellus, we've historically advocated the benefits of a concentrated portfolio. How do the number of stocks in Meritor justify or explain the difference with the other Marcellus's portfolios?
So, I mean, the first, the reason I would say is, why we, went with this, a bigger portfolio is, again, it wasn't, something, which we thought about, too consciously. It was actually an outcome of, our research, where we felt, again, basis, the returns and, the various analysis which we did, the past, how this portfolio would have behaved in the past. And also because remember that, it's not right to just directly compare the, a quant portfolio with, a discretionary or, a normal, a traditional or, portfolio related to a traditional process. The simple reason is, again, fund manager, who is, like I said, a human fund manager is also including a lot of non-quantifiable information, right? And also remember, we are, buying a stock, we are doing corporate governance checks, we're talking to the suppliers, so many other things. So lot more information. And again,
Krishnan, if you don't mind stepping in. So, folks, the quant and qual investing works very differently. So, on qualitative investing, the way say CCP, LCP is run, there's plenty of research which shows that when it comes to qualitative investing, portfolios of more than 30 stocks are very difficult for fund managers to run because, as Krishnan is saying, it's very difficult for a fund manager to do extensive channel checks, deep diligence on more than 30 companies. It's simply not humanly feasible. So, across the world, there's research which shows that qualitative portfolios run by teams of analysts of more than 30 stocks are very difficult to manage successfully over extended periods of time. On the other hand, a quant algo, the sort of algo that Omkar is applying to Meritor Q, a quant algo can be applied as efficiently to 30 companies as to 300, as efficiently to 300 as to 600. Right? And what a quant algo does, what quant investing is very good at, and there's again plenty of research. In fact, there's newsletters that we have published on our website, which you can go and refer to. What quant is very good at is giving you breadth, right? Krishnan, if you actually don't mind turning to that slide, there's a slide on this. What quant investing is very good at is analyzing lots of information across hundreds of companies. वो वाला slide ओंकार अगर आप ले आओ वो breadth वाला slide, right? Quant is brilliant at analyzing lots of information across hundreds of companies and doing so repeatedly, quarter after quarter after quarter. A human being, a qual fund manager, is very good at going deep into 20-30 stocks. नहीं ये वाला नहीं और एक slide है ना आगे इसका अगला वाला slide होगा, right?
the next slide.
So a qual fund manager goes deep, a fund manager goes wide, right? So width, breadth is the skill that a quant fund manager is able to bring to the table by creating an algo, right? As the chevrons here show, as the arrows here show, by creating a process which is repeatable, data driven, is applied to hundreds and hundreds of stocks, right, across large number of securities. You rebalance every 3 months. When we are doing it every 3 months, because the back testing told us that 3 months is the optimal time period. Some people do it they rebalance every 6 months. Some people rebalance every day. Our back testing told us that rebalancing every 90 days is the way to go. So this is where the way quant works is width panao, breadth panao, repeatedly algo chalao, and frequently rebalance. Qual works in saying deep jao, right? Understand 20-30 companies in enormous detail, do your PhD thesis in that. That's where a qual fund manager builds edge. Edge banta hai qual ka depth mein, quant ka edge banta hai width mein, and in the cleverness of the algo.
And in terms of the price to free cash flow or free cash flow yield, is there an absolute yield that we look for, or is it relative to the universe or relative to the benchmark?
It is relative to the universe.
So you pick the highest free cash flow yield after you've done all the other steps.
Yes, but relative to the universe.
Got it. There's a very interesting question. I guess this is from a small case investor. They're saying that, look, is there any way to automate the rebalancing? Because when it comes to a small case, the investor has to press the rebalance button. And often that throws up the number of stocks that are coming in, coming out. And that subjects the investor to some bias or action bias itself. Sometimes you say, looking at the stocks, okay, I shouldn't buy this. And as a result, they end up digressing from the stated philosophy and lose all the advantages of quant killing the bias. I don't know if there is a straightforward answer to it, other than the fact that if you give your money to us in the PMS, we'll do it eliminating your bias. But let's say somebody doesn't have the option to invest in the PMS. Are you aware of any way to automate it using your quant skills or coding skills?
No, at least I'm not aware of it today. So it's, look, the easiest thing to say is, like you rightly said, right? Go for the PMS in that case.
Look, one simple way would be, if you're doing it on the small case construct and Krishnan triggers the rebalance, don't look at the stocks. If looking at the stocks makes you, it gives you human thoughts, right? You're a human being after all. If looking at the stocks gives you human thoughts, then don't look at the stocks. Like, cover the screen with your hands and press the execute button, right? So I do that in the treadmill in the gym. If I keep looking at the treadmill, I feel more tired. So I cover the treadmill with a towel so that don't see how many minutes I've been working out. So that way, if I block out the time factor from my head, I'm able to run longer. So you can put a towel on your laptop or in your phone and hit the rebalance button.
Right. Saurabh, there's a question on if I have only one fund to choose from between Meritor and your global compounders portfolio, which one do you recommend? I'm not sure if it's comparing like for like, but
Okay, so let me first give the answer that I've given elsewhere, the answer that I apply to myself, right? Which is that um, uh, uh, given that I live in India, but I'll have children going abroad to study most probably. Given that, like many of you, my phone is imported, my iPad is imported, my bulk of the parts in my car are imported. If I take a local flight tomorrow I'm going to take a domestic flight. Effectively, the domestic flight is imported because nothing about that domestic flight comes from India, right? So given that I live here, but most of the stuff that I'm using is imported, I have tried to have 30% of my wealth in global securities and 17 local securities, right? 70 desi, 30 global. I believe that's the appropriate mix because there's no point having 100% of your equities in 100% of your equity portfolio in Indian savings. If the bulk of your liabilities is in dollars, if the bulk of your outgoing is in dollar, no point having 100% of your savings in rupees. So I've suggested 30/70. I've done it myself. But say whoever's asking the question, you say, "नहीं, मेरे को 30/70 नहीं करना. I only want to have my savings in one currency, or for practical reasons, I can only afford one portfolio." Right? If you can only afford one portfolio, the first practical consideration to keep in mind is GCP, the minimum is 25 lakhs, whereas Meritor Q PMS, the minimum is 50 lakhs. As per SEBI's rules, the minimum here is 50 lakhs. In global compounders, the minimum is 20 lakhs because it's a PMS based out of Gift City, which is a different jurisdiction. Right. So from a minimum perspective, GCP is a easier portfolio to build because the ticket size is smaller. If you're saying that, look, 25 lakhs, 50 lakhs, that's not a consideration. I just want to choose one portfolio, then I would say choose the Indian portfolio. Choose the Indian portfolio because the bulk of your spending in life is bound to be inside India. And if you can only choose one currency to save in, and you don't have the luxury of saying, I'll build two portfolios, then choose the Desi portfolio, which is Meritor Q.
Right. So there are questions around the minimum ticket size. Like Saurabh mentioned, on the PMS, it's 50 lakhs. But I wanted to make one clarification here. We've made a recent change for investors who already invested 50 lakhs in any of Marcellus's portfolios. You can now avail the new offer of investing a minimum of only 25 lakhs in Meritor. This is open to Meritor only, because the regulatory requirement is to have a minimum of 50 lakhs at the PAN card level. Provided that you have 50 lakhs with us in any of the portfolios, the incremental investment into Meritor drops to 25 lakhs. Questions around the returns. Returns expected, I'll leave it to you, Krishnan. But whether it's open now, of course, it's open now. Both in the PMS construct and the small case construct. And the small case minimum investment, Krishnan, would you be able to help our investors?
Yeah, it's right now around 4,30,000.
Right. And in terms of expected returns from Meritor, how should our clients be thinking about it?
Onkar, do you want to comment on that?
Yeah. So post taxes, like I said, promote, even after considering all fees, 17% is the expected figure.
I think post taxes is not our prerogative. No, so focus on the pre-tax figure. What an investor does with taxes is their prerogative. So the number that's the actual realized number that we showed you in the last 19 months, the actual realized number is 18.6 net of fees, and high teens, low 20s. High teens, low 20s is a reliable figure for what's likely to transpire in the years ahead. उसके बाद the tax consideration kicks in, and that's your prerogative, much like in whether it's mutual funds or PMS, this PMS or any other. The tax piece is a function of the exit decision.
Fair enough. There's a question on why does Marcellus not offer this product directly, but through small case? Well, I mean, we don't have the technology. There's the value add that small case does in terms of simplifying your buy and sell trades. The moment you say subscribe to Meritor or rebalance Meritor, there's an underlying algo which disaggregates that one instruction into several buy and sell trades, which in turn connects to several brokerages, including whatever brokerage you might work with. So there is a specific technology. Remember, we are not a technology company. While we would like to believe that the Python code that Omkar and Krishnan write gives us some claim, but it's too far-fetched. We'd like to focus on what we know best, which is investing, and outsource whatever aspects to the best of breed vendors there. There's a question around use of derivatives to the extent that there are funds out there which have used quant methods but executed those quant strategies using derivatives either for hedging or levering the portfolio. What are our thoughts on that? We understand you might not want to do it on a qualitative portfolio, but in a quant, presumably it should lend itself to use of derivatives.
Sure. So, I mean, right now we are not using derivatives at all here in Meritor Q, nor do we have any plans. But yes, I mean, one has to be careful. I don't think we'll ever use derivatives even here, on the quant side for any products, where we lever ourselves up, right, using derivatives. Maybe for hedging, right? But again, something we need to be extra careful about, because if there's any one area, right, when you look back at again some of the big quant meltdowns or big quant funds which have collapsed, whether it's LTCM, and there are a lot of other such examples, derivatives one way or the other is the main culprit, right? So we need to be extra careful when we do this. But right as of today, there's nothing, we're not using derivatives in Meritor Q, nor do we have any plans.
Right. There's a question around, I guess this is somebody who reads our 3 longs and 3 shorts. They've said you published a few articles about Renaissance Technologies, perhaps the greatest quant fund in history. Anything we can learn from Jim Simmons? Anything we learn? I mean, I guess it's been a black box all through, but I'll leave that to you, Krishnan. Is there anything from the success of Renaissance that we can incorporate in Meritor?
No, look, I mean, the bread point, which Saurabh mentioned is, it's classic, right? Because again, what Jim Simmons has almost always said is he has almost zero knowledge on, the stock he invests in, right? So he's just looking at numbers. And, again, they're doing it over, a very large number of stocks, and they, figured out a way to do it very efficiently, getting in and out of companies, with at the most, within a day or, within a week. And yeah, I mean, that's how, it seems they have made money, right? So there are lots of ways of, making money. High frequency trading, again, a lot of firms, do really well there. Rentec, again, is one of the, one of the most successful high frequency trading firms. So yeah, I mean, they have figured out, one way to, make money for their investors. But again, again, there are different ways, right? So even within quant, you have high frequency trading and, this kind of, more quant and fundamental kind of investing. And obviously, there is other medium frequency, other, different, whole set of strategies, which fall in the spectrum. So yeah.
So if you read this book, right, Krishnan is far more mathematically literate than I am. Although Krishnan, you haven't yet got your maths PhD. And Omkar, आपका stats PhD कहाँ पे है? So jokes apart, in Rentec, right? From reading this book, what I understood was they're able to do three things, which are very hard to do in India. Pehla, they're able to do they're able to use vast amounts of leverage, right? They're able to borrow money from the Wall Street banks at incredibly low cost and put on leveraged bets. So Krishnan's belief in investing is not only derivatives mat istemal karo, but leverage bhi mat karo. So the return that Omkar showed you, 18.9, is unlevered. If you give Omkar leverage, say just three times leverage, Omkar will give you returns north of 50%. And Omkar will also start, he already has a bit of a beard. If he also starts chain smoking, right, he'll also start becoming a guru type person, the sort of hero who's featured in this lovely book, right? Brilliant book by Greg Zuckerman, right? The pehla cheese, Rentec uses enormous leverage. We don't want to use leverage, and neither will Indian law. Indian law mein leverage use karna allowed nahi hai. We can't call up, our bankers and say leverage de do. We want to lever up. Meritor Q allowed nahi hai. RBI rules don't allow that. Dusra is, these guys, the Rentec guys, use hundreds of trades, right? They're trading fraction of a second, mein, right? So just to give you a sense, at least basis the book, what I understand their process to be is, their process is much like, say, you say, when you write on your phone, no, the phone now has recognition inbuilt into it. So if I write, say, Shah Rukh, the phone will realize कि ये शाहरुख खान की बात कर रहा है. The phone will auto predict Shahrukh Khan, right? So the phone has basic auto prediction built into it, and similarly, the algos are not just using auto prediction. Their algos are also using natural language processing. So when I tell Siri, when I tell मेरा iPhone का speech assistant that Siri, get me a cab, Siri doesn't really understand Saurabh's speech, but Siri has been programmed to say that when Saurabh says these words, get me a cab, it does a vast lookup from a colossal database and figures out that I need a taxi. Rentec seems to have used the IBM ka Watson team. The first IBM Watson was the first natural language processing experts in the world. वो पूरा team Rentec ने hire किया, किताब में लिखा है. पूरा team hire किया, and they applied that concept that if you analyze tons and tons of data, the data can be made to predict आगे क्या होगा. They apply that to not just stocks, US bonds, currencies, pork belly futures, orange juice, grain, कुछ भी नहीं छोड़ते, right? So they are doing heavy leverage, high frequency trading, and across lots of commodity classes, right? तो इंडिया में तो none of that is possible. Liquidity नहीं है स्टॉक मार्केट में हाई फ्रीक्वेंसी ट्रेडिंग करने का, leverage हमको मिलेगा नहीं, and I don't think as yet pork belly trading is happening. There's some commodity trading happening, but we simply don't have liquidity in the Indian market. All of that being said, as the book explains, everybody there is a PhD in physics, maths, stats. आई डोंट थिंक वो हम जैसे लोग इकोनॉमिक्स एमबीए वाले लोगों को घुसने भी देते हैं. मिनिमम इज पीएचडी, मिनिमम क्वालिफिकेशन इज पीएचडी इन physics, maths, or stats, which I'm sure in due course our illustrious colleagues on the screen will also aspire to attain one day.
As long as they don't do an MBA. In fact, our global portfolio manager, Arindam, did apply to Rentec. He wasn't even given an interview because he had an MBA. So be careful. If you ever harbor any ambitions of working for this firm, it needs to be a maths PhD at best. So here's a lovely question. What do you think are the lessons we can take from the Meritor experience? So let's not call it a success yet, from the experience into our qualitative portfolios.
Yeah, brilliant question. I think, Krishnan, if you, Onkar, if you don't mind beaming up that slide showing that Meritor Q is consistently cheaper than the BSE 500, right? I think we've learned a lot from watching Krishnan build these algos, test these algos. And for me, the biggest lesson, थोड़ा सा पीछे जाओ उनका, I think 2-3 स्लाइड पीछे है, right? और पीछे जाओ. Just go back, Onkar. Back. So the biggest lesson for me, back again, right? Back again. Haji. This was, I've watched him do this over the last 2 years, right? He came, he coded away for 6 months. Omkar and Krishna did lots of testing on Python. The fact that they were able to both show us theoretically 2 saal pehle and now practically that you can build a portfolio, the solid black line, you can build a portfolio which is consistently cheaper than the market, and yet go forward one slide, Omkar. You can build a portfolio which is consistently cheaper than the market and yet is better quality than the market. Look at the ROCE. Meritor Q का ROCE 30% है, BSE का ROCE 20% के आसपास है. You're cheaper and you're better, right? The fact that this is doable in India, I think we owe a big debt to Krishnan and intellectual debt to Krishnan for showing us the ho sakta hai. And then, quarter after quarter, as Omkar has run this, Krishnan has provided the intellectual horsepower. Quarter after quarter, as they've gunned out steady returns, and I've learned a lot that this is doable. Technology is allowing us to do it, and that discipline we are trying our level best to weave into Little Champs, Rising Giants, and indeed across the whole firm. So, enormous intellectual debt to Krishnan for this, right? To show us that it can be done, to implement it, to run real money, and Onkar crunching out these algos quarter after quarter, Krishnan doing the small case thing. I think just a treat to watch this. And the fact that it's all mathematically done, koi judgment nahi hai. Mathematically done. That's tremendous. I mean, just if I could, if the 25-year-old Saurabh or even the 35-year-old Saurabh could have been given ye wala jo slide, the one that we are staring at, I would have been a wiser man. I would have lost less hair in the last decade or so.
So just one last thing related to that is, just like we've seen the value of shifting from small cap to large cap and large cap to small cap, depending on the cycles. Given CCP is largely large cap oriented, aren't we missing out on this ability to be more flexible on at least on the size factor?
Yes, I think it's a good point, and I think one of the things that we need to reflect on as a house is how to make our clients benefit from that. Today is at this juncture, given the point that we made on how attractive large cap valuations generally are, and certainly large cap valuations are attractive, and in that context, CCP valuations are very attractive. Given that that's the case today, it's not going to be very far away. 2-3 saal hi lagega when small caps will be completely destroyed, right? Utterly destroyed, and small caps will be super active. I think we as a house need to reflect on how to help our clients toggle between large cap and small cap. It's very difficult to build a portfolio which says very difficult to build a qualitative portfolio. Very difficult to build a qualitative portfolio where the fund manager says, I'll go from 70% large cap to 70% small cap. I haven't seen such portfolios which go so radically from large cap to small cap. But we as a house can advise our clients to ramp up on CCP and ramp down on LCP, and then at certain junctures ramp up on LCP and ramp down on CCP. I think we as a house need to reflect on that whilst we are doing that and promote. You're the most likely person to be able to do that. Whilst we are doing that, what Meritor Q can help clients achieve is within one portfolio that toggle from large to small when small is looking attractive, and then small to large when large is looking attractive. The quarterly rebalancing fulfills that objective quite nicely.
Super. This was fascinating, super fun, guys. Thank you so much, Omkar, Krishnan, and Saurabh, and thanks to all our listeners for your time. Hope to see you shortly with the next edition of the webinar.
Thank you.
Thanks, folks.
Thank you.
Thank you.